Hi, I'm Jim Ayres, Chief Investment Officer at Pacific Portfolio Consulting, a $4.4 billion registered investment advisor in Seattle, Washington. With the market setting new highs on an almost daily basis, it's increasingly common for us to get questions from clients about whether or not the market's getting frothy. When we say frothy, we mean the market is starting to heat up. Investors are starting to take on more risk than they had previously, and they're starting to listen more to that greed impulse than that fear impulse. So this leads them to put more money into the equity market, drive prices higher than they would otherwise, and basically take on behavior that isn't so much considering the risk aspect of their portfolio anymore. Investors have a tendency to anchor onto recent developments and then take those and project them out in the future. So economic growth has been good, earnings are gangbusters, companies are beating on revenue estimates. There's a lot of good news coming out right now. The market is discounting it, and that's sending stock prices higher. Investors have a tendency to assume that things will continue to get better and project that out in the future. That causes them to pay more for stocks in this environment than they would have, say, in a more muted economic environment where earnings weren't quite so robust. So there's definitely pockets of speculation out there. They're not in any major segments of the market. They're in kind of the darker, riskier recesses of the market, in the crypto market or the meme stock area. The broad market as a whole really doesn't look all that frothy to us, or at least not yet. There's areas where valuations are high. In the market's darlings, the growth stocks, valuations are high. Now, the broad market as a whole probably will do just fine. The market's looking ahead. It's looking ahead to next year and the year beyond that with good economic growth and good earnings growth. Valuations will come down and the market should look more reasonable at that point. The overall market, as I said before, isn't cheap, but we don't think it's frothy at this point. And I don't want to give the impression that you don't want to own growth stocks. You're going to want to own them. If you had abandoned them earlier this year when it looked like value was going to do better, which it did for a time, you'd be kicking yourself right now as you look backwards saying, oh gosh, look at what I missed. That's where a diversified approach comes into play. You should own growth. You should own value. You should own domestic and foreign and large, mid, and small. It should be based on a broad asset allocation view. And we really discourage any kind of market timing approach that would say, okay, now I'm going to move to growth. Okay, now I'm going to move to value. We think, frankly, value will do well, growth will do well. The U.S. market, we believe, as a whole will do well based on what is, frankly, a relatively favorable outlook for the economy and for corporate earnings. So looking back at investor sentiment and risk appetite, the frothiest environment you can see in recent history is really late 2017, early 2018. Everybody owned stocks. Everyone was short volatility. People thought volatility was going lower and lower and lower. No one was thinking about risk anymore. It led a lot of people to get over their skis and really have more risk exposure than they realized or probably would have wanted in a more normal environment. With regard to frothy versus bubble, as I mentioned before, frothy really is when enthusiasm starts to build and greed starts to dominate over fear. I think the difference between that and a bubble environment is really one where the fear of missing out has taken hold. People are no longer worried that the fear of losing money has disappeared and it's all about, I need to be in this market or I'm going to miss out on something incredible. And valuation at that point is meaningless. It is all about speculation, getting in. I don't care what I'm paying right now because I know I'll get out at a higher level. Someone will buy it from me at a higher price. We're nowhere near bubble territory. The pockets of froth that I referenced earlier are clear examples in our mind of bubbles. So cryptocurrency went through a bubble. SPACs last year and early this year went through a bubble, the special purpose acquisition companies. And then the meme stocks, which have given us no end of grief, have been kind of this rolling bubble as retail money just drives these stocks to absurd levels. And price at that point has completely separated itself from value. There's no rhyme or reason other than I'm going to buy this because it's going up. Frothiness is probably the seed stage of the bubble. We could see the market be really enthusiastic for a while. And as I said, we think that enthusiasm will be validated without ever getting into bubble territory. But if we reach a point, and this is why we watch those pockets of speculation, if we start to see that sentiment move to the broader market where it's all about, I need to be in stocks, I don't care what I pay, it's only going up, kind of reminiscent of the attitude towards real estate back in 2006, 2007. At that point, we'd start to be concerned, but we're not seeing that right now. And as I said, we slice and dice risk appetite and investor sentiment as many ways as we can. And it's very interesting. We see the market start to get a little bit heated up, and then it's able to pull itself back and calm down. And that's, in some cases, that's due to uncertainty over what the Federal Reserve will do with interest rates. Part of it is due to the Delta variant COVID numbers going up. Every time we see appetite start to get a little ahead of itself, it's able to cool down fairly quickly and come back to a more rational level. As long as there are things to worry about, that acts as a good check and balance to irrational behavior. It's important for there to be a component of fear in the market. It should be a rational decision that balances return against risk. And as long as there is uncertainty about how things will go, you have people making more rational decisions. As we said before, once you reach that speculation phase, there's no debate at that point. Obviously, an investor's natural instinct in a frothy market is probably going to be to push further into it, right? Things are looking good, investors are feeling good, prices are going up. That leads them to want to move more into the market. The other side of that is going to be people who get worried when they start to see prices go up, they start to see valuations go up, and they say, oh, the market's too high. I have to back away from it. And they start moving to cash. When clients try to time the market and move to cash, they rarely, even if they get the exit timing right, they rarely ever get the re-entry right. And we've seen, unfortunately, some people sit on the sidelines for years and watch entire bull markets slip through their fingers because they got spooked and moved to cash at the wrong time. You know, it's going to be really hard to find a whole lot of opportunity right now in the most favored areas of the market. The large cap US growth companies, everybody owns them, everybody follows them. There's not many rocks to be turning over there. Really, I would go back to saying, stick with a diversified approach to make sure that you own the value companies, you own the small cap companies, you own emerging markets, for example. Emerging markets have gotten battered in recent months because of the COVID problems they've been experiencing. That's not going to go on forever. They tend to be very robust growers. Once they get through this COVID environment, they're going to be areas you're going to want to own. Now, the problem is you can't wait until they come through that. It always comes back to the discounting mechanism. The market is looking forward at what's going to come, not what's going on right now. So this would be a time when you want to have exposure to that. We think having a diversified approach, globally allocating to developed and emerging markets and all the various market caps and styles within those markets is the way to go. That way you don't necessarily have to try to get the right style or market capitalization for a particular period. You've got exposure to it on a strategic basis.